The S&P 500, you've probably heard of it, but do you know why it's one of the most talked about indices in the world? Whether you're new to investing or just curious, this video will break down everything you need to know about the S&P 500 and whether it's the right investment for you. Let's start with the basics. What is the S&P 500? The S&P 500 is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. These are companies you likely interact with every day, like Apple, Amazon, Microsoft, and Coca-Cola. But here's the interesting part. The S&P 500 doesn't include just any company. It's carefully curated to represent a broad snapshot of the U.S. economy. Why is it called the S&P 500? The S&P stands for Standard & Poor's, the company that created the index. And the 500? Well, that's for the 500 companies it tracks. Simple, right? So, why does the S&P 500 matter? It's considered a barometer for the overall health of the U.S. economy and the stock market. When the S&P 500 goes up, it usually means that most major companies are doing well. When it goes down, it's a sign that the economy might be slowing. Now, let's talk about why investors love it. First, it's diversified. Because the index includes companies from a wide range of sectors, like technology, healthcare, finance, and consumer goods, it spreads out the risk. Second, it's passive. Many people invest in the S&P 500 through index funds or ETFs, which means you don't have to pick individual stocks. And third, it has a proven track record. Over the long term, the S&P 500 has delivered average annual returns of around 7 to 10% after inflation. That's a solid performance for long-term investors. But wait, is the S&P 500 a guaranteed moneymaker? Not exactly. While the index has historically performed well, it's not immune to volatility. For example, during the 2008 financial crisis, the S&P 500 lost about 37% in a single year. However, those who stayed invested eventually recovered and saw gains over time. At this point, you might be wondering, should you invest in the S&P 500? Here are some things to consider. First, the S&P 500 is ideal for long-term investors. If you're looking to grow your wealth steadily over the years, it's a great option. Second, it's perfect for those who prefer a hands-off approach. You don't need to spend hours researching individual stocks. An index fund does the work for you. And third, it's an excellent way to diversify your portfolio, especially if most of your current investments are concentrated in a single sector or region. But, and this is a big but, it's not for everyone. If you're looking for high-risk, high-reward investments or prefer to have more control over your portfolio, the S&P 500 might not align with your goals. Additionally, because the S&P 500 focuses on large-cap companies, you might miss out on the growth potential of smaller, up-and-coming businesses. Before we go further, let's take a quick moment. If you're enjoying this video and finding value in it, make sure to hit the subscribe button. By subscribing, you'll never miss out on insightful content that can help you make smarter financial decisions. Now, back to the question at hand. How do you invest in the S&P 500? The simplest way is through an index fund or ETF. These funds are designed to mirror the performance of the S&P 500, and they often have low fees compared to actively managed funds. For example, you might consider the Vanguard 500 Index Fund or the SPDR S&P 500 ETF, which are among the most popular options. Investing is simple, but don't overlook strategy. Dollar-cost averaging is one approach you can use. Instead of investing a lump sum, you spread out your investments over time. This strategy helps you take advantage of market dips and reduces the impact of market volatility. Remember, consistency is key. Another question you might have is, how much money do you need to invest in the S&P 500? The good news is that you can start with as little as a few dollars if your broker allows fractional shares. This makes it accessible to almost anyone, regardless of budget. Now, let's dive deeper into the history and structure of the S&P 500. Did you know the index was first introduced in 1957? That's right. It's been around for over 6 decades, evolving alongside the U.S. economy. Initially, it only tracked 90 companies, but as the economy grew, so did the index. Today, it's a powerhouse of the financial world, influencing trillions of dollars in investments worldwide. The S&P 500 isn't just about tracking big companies. It also has strict criteria for inclusion. For a company to be added, it must meet requirements like a minimum market capitalization, positive earnings in the most recent quarter, and a majority of its shares available to the public. This ensures that only the most robust companies make the cut. Another fascinating aspect is how the S&P 500 is weighted. Unlike some indices that give equal weight to all components, the S&P 500 is market cap weighted. This means that larger companies like Apple and Microsoft have a greater influence on the index's performance compared to smaller companies. It's a system designed to reflect the real-world impact of these corporations on the economy. But what about taxes and fees? If you're investing through a tax-advantaged account like a 401k or an IRA, you can benefit from significant tax savings. On the other hand, if you're using a regular brokerage account, you'll need to consider capital gains taxes on your profits. Additionally, while index funds and ETFs are known for their low fees, it's still crucial to compare expense ratios. Even a small difference in fees can add up over time, affecting your overall returns. Let's also talk about risk management. While the S&P 500 offers diversification, it's not immune to market downturns. To mitigate risk, consider diversifying further by including international stocks, bonds, or alternative investments in your portfolio. And always remember, investing is a journey, not a sprint. Patience and discipline are your best allies. To further enhance your understanding, let's explore some myths about the S&P 500. One common misconception is that it's only for wealthy investors. This couldn't be further from the truth. With fractional shares and low-cost ETFs, anyone can start investing in the S&P 500 today. Another myth is that the S&P 500 is only for Americans. While it does track U.S. companies, many of these corporations operate globally, making the index relevant for international investors as well. Now, let's address some frequently asked questions. First, what happens if a company in the S&P 500 underperforms? Companies that no longer meet the inclusion criteria are removed and replaced with stronger performers. This dynamic nature ensures that the index remains a reliable benchmark for the market. Second, can you beat the S&P 500? While some active investors and fund managers attempt to outperform the index, studies show that the majority fail to do so consistently over the long term. That's why passive investing through an index fund is often recommended. Finally, let's talk about the global impact of the S&P 500. Did you know that many international funds and indices use the S&P 500 as a benchmark? Its influence extends far beyond the United States, shaping investment strategies and economic policies around the world. This makes it a cornerstone of the global financial system. Now, let's wrap it all up. The S&P 500 is a powerful tool for building wealth. But like any investment, it comes with risks. It's best suited for those with a long-term mindset and a desire for diversification. If that sounds like you, the S&P 500 could be a great addition to your portfolio. So, what should you do next? First, research your options. Look into index funds or ETFs that track the S&P 500 and compare fees. Second, determine your investment strategy. Will you invest a lump sum, or will you use dollar-cost averaging? And third, take action. The best time to start investing is yesterday. The second best time is today. If you found this video helpful, let's keep the momentum going. Here are 3 quick things you can do right now. 1. Smash the like button to help others discover this content. 2. Hit subscribe and turn on notifications so you can join us for more videos like this one. And 3. Comment below with your thoughts or questions. I'd love to hear from you. Thank you for watching, and I'll see you in the next video.